I started Upper90. I'm the co-founder and CEO of the company. And what we do is we provide credit and equity to profitable tech companies. And the way we see it is that every business has a healthier part and a riskier part. Traditionally, startup founders have relied on equity to grow. If you're a startup, you raise equity. And if you're an offline traditional business like real estate, you raise debt. And the common equation here is data. And so we can identify assets within tech companies that have real value, fund those with credit, and allowing the founder to raise less equity. And the real reason is, why do we do this? So what we like about OurCrowd is they're disrupting the traditional way that you invest into private companies. And VC as a category talks about innovation and disruption. The industry itself has not changed much in 20 years. And so what's happened is, as VC has become larger, the checks into companies has become larger. And after a Series B equity round, founders have sold the majority of their company. And so Upper90 was started to help founders own more of their company. And we can do that by making credit available earlier. Credit typically is only available to startups once they've raised a lot of equity or once they become to a certain size and are bankable. And I come from quant trading. I spent most of my time at Goldman Sachs doing that. And I've learned that the best investors have an informational advantage. So what we do is we provide credit to companies early. We get paid to learn through the credit. I'll give you guys a few examples. And from that position, we're able to form a view on equity. So once we see the company performing and growing, through our credit, we're able to then create unique investments into the equity. So most PE, most venture capital, you pay to learn. We get paid to learn, and it's a massive advantage. As a firm, we have $1.4 billion of AUM. This is our third fund. We do 90% senior secured credit, which is meaningfully downside protected, and we do 10% equity. Our credit funds have delivered north of 20% net IRRs to our investors. Our first fund was launched in late 2018, has already returned 100% of the fund to investors. Our second fund was late 2020, has already returned almost 50% of the fund to investors. So when you have a short duration credit strategy, to everybody in this room, you're able to have a much more predictable return of capital. And I think everyone's kind of mispriced this illiquidity premium where you have to wait 10 to 12 years to get your returns. And what I mentioned before, one of our companies, which does a lot in Israel and abroad, when you download an app on your cell phone, which is a multi-billion-dollar industry, Apple pays that small business app developer 60 days later. Like every small business, they need money today, and Bravo will factor that app receivable, paying 90 cents to the app developer today, and will get paid by Apple 60 days later. We've been getting as Upper90 15% to take 60-day Apple payment risk. So I think there's so many new businesses starting online where credit is available, which has not been the case in the past.
Thank you. Just a quick question. I know we're running out of time. You said the first two funds generated IRRs of above 20%. What can investors expect for this fund?
It's a very good question. The last 4 years, equity has been very inexpensive, and it's been hard to convince founders to take credit when equity's been very cheap. So we're entering an environment where equity is very expensive, rounds are not getting done. We're able to take advantage of that. Our stated return target for the fund, which is now available in OurCrowd, and the majority of the fund has already been raised, is 15% net. And I think there's room in everyone's portfolio for that. We've outperformed our first two funds, but I think I'm very comfortable sticking with our target and hopefully outperform from there.
Thank you. Thank you very much.
Thank you to OurCrowd, and thank you so much.